Hello, good morning, everyone. I'm going to give everyone just a few moments to come into the webinar, and then we'll get things kicked off. All right, well, I think we're going to have a really great crowd today, so I'm super excited to make this presentation to you. So again, hello and welcome to Crack the Tax Code. This webinar is really designed to help provide you with information on how to save big on taxes. We're here to unlock the cash vault so you can keep hundreds of thousands of dollars of real take-home money, money that you have earned through your business. So as we kind of get things rolling, some quick housekeeping notes before we jump in. If you have any questions, please put those in the Q&A and we'll get them answered at the end of the webinar. If we don't get to your question, we will send a follow-up message so that you get that question answered via email. And of course, you can always email us if you have any additional questions. So a little bit about us. We are Unboxed advisors, and we are personable accountants. We're altogether different than the other traditional firms that you might find out there. One of the great things about us is that we are super focused on helping you to make more money, how to leverage all the parts of your business to increase the profit that you keep in your pocket, while simultaneously saving you money via taxes and strategic tax planning, and helping you to protect the wealth that you're building through risk mitigation strategies. So we're super focused on working with business owners and entrepreneurs to that end. We want to make sure that you're building super valuable businesses and really hanging on to all the money that you can in the process. We know you work exceptionally hard, so that's our job. Our Unboxed team. So my name is Susan Bryan. I'm a CPA and certified tax planner. And with us today, we have Catherine Meyer, who is the co-founder of Unboxed Advisor and the COO of our firm, as well as Brittany Eden. Brittany is an enrolled agent and also one of our tax advisors. So this is your Unboxed team, and I want to make sure everybody was very familiar with who we are and knows who to reach out to. Our contact information here. Also, feel free to reach out to us on LinkedIn or follow us on Facebook too. Okay, awesome. So we're going to jump in. We only have an hour and there's a lot to cover when it comes to tax planning. So what is tax planning exactly? So tax planning is the practice of using current financial information from your business and from other personal sources of income and forecasted income data to project what your liability is going to be for the year, and then uncover opportunities to save taxes by making different decisions that really impact what that burden is. Unfortunately, many business owners simply accept whatever their tax liability is on April 15th for the preceding year, and they never work with someone to alter what that looks like. We are believers that we get to decide how much to pay in taxes. And we do that by understanding how to leverage every aspect of the tax code in order to make proper planning decisions and making sure the timing of that is just right. So first things first, we're going to really talk about all the things you need to be contemplating before you really jump into any type of tax planning. So the first thing I'm going to say is that you've got to get rid of the transactional CPA. Many people, business owners, work with a tax preparer who is simply taking the numbers that they give them and putting them into a return, and they think that that person is giving them advice on how to mitigate taxes, and that's just not true. The tax advisor is the person who is going to be more forward thinking and going to develop a relationship with you to understand what is happening in your business today, what are you expecting to happen tomorrow, and how do we impact that through decision making. Beyond just tax preparation and tax advisory, the relationship that you're forming with a CPA and a holistic business advisor is really to gain as much information from that person as possible from this relationship. So your tax advisor, CPA, and business advisor is really the person who's connecting you with so many other resources that can help make your business more effective and more profitable, and ultimately help to create an ROI on all of those relationships. One of the most important things is to have a relationship with a CPA who you talk to on a very frequent basis, where you're checking in monthly, quarterly, so they understand what you're doing or what you're planning to do, so that they can provide preventative and proactive advice and information as to how that's going to impact your taxes. And of course, always consult with your accountant before you make any big moves. You really need to be viewing this person as your advisor to your business. It's more like a partner, just like you do with your attorney, your financial advisor, your insurance broker. Get to loop them in periodically. And it's one thing that we really believe in here at Unboxed Advisors, is that it's really developing this team of people around you as a business owner to advise and direct you in a holistic manner. All right, so investing in those relationships is just super key. Before you get started with any planning, once you've got your advisory team in place, now you got to make sure that you've got solid accounting records. Without good accounting records, planning is virtually impossible. So you've got to have your accounting records updated and keep them updated. Accounting is a regimented and disciplined practice within your business, and you really have to look at it that way. So if you are not getting good information on a routine basis, even to make business decisions, then certainly tax planning can almost for certain not be done. So it's just like you wouldn't ask a doctor to operate on you blindfolded. The same goes with tax planning. You really cannot have any tax planning done without having a good, solid accounting records and financial information. And that not only includes what's happened in the past, but also developing a forecast to understand what's going on in the future. Additionally, tax planning should not be viewed as a one-time thing. Generally speaking, there are activities that have to happen at the onset when people begin working together. Something that we believe in here at Unboxed Advisors is at the onset of every new relationship, we're taking the time to understand and plan initially. Where are you? What things haven't been done in the past? What do we need to do right now? And then every year going after, we must update the plan. Business changes, life changes, the economies change, interest rates change. I mean, change is the one constant we can guarantee is going to be occurring in business. And so tax planning has to evolve, and it's not a one-time event. So keep focused on that too when you're developing a relationship with an accountant, that you're really focused on how do I integrate this into an ongoing engagement with them. It has to be something that's updated. Let me also say that tax planning should be started earlier rather than later, because in many instances, the more taxes you are looking to save, the more complex the strategies become, the more the education process is going to take. That it is important for business owners to understand the process by which taxes can be saved. Some of these strategies, you're not going to just hear it one time and be like, got it, I know exactly how I want to proceed. Sometimes it's more than 3 times to truly understand, okay, tell me how it works. Well, let me talk to the expert, maybe a specialist who is going to help implement it. Let me understand the cash requirements. So spending some time and making sure you're starting usually in about the September-October timeframe of really kind of honing in on those key processes. And there's also not usually a silver bullet for minimizing taxes. You're not going to find that there's just one strategy that's going to eliminate your tax liability completely. Really adopt this this philosophy and this openness to understanding you're going to be chipping away, whittling away at the tax liability via a multitude of strategies. So really kind of understanding that when you're working from a tax advisory standpoint, it is chipping away little by little at that liability. Finally, focusing on ROI and not the DIY. You're going to learn a lot in this webinar today about tax planning. But one of the things we caution all people on, especially business owners, is that you can go to Google University. You can learn a lot here too, but executing becomes altogether different. So invest in tax planning. We know that when you are paying an accountant, that's much better than paying the IRS. So take the time to sort of evaluate what exactly is my ROI when I invest in having someone do this for me and execute it on my behalf. So ROI, not DIY. I mean, I know many of you, I've said this many times, we're not changing our own oil. We're not cutting our own lawns. We don't clean our own houses. But for some reason, when it comes to tax planning and even some basic things like accounting and bookkeeping, those are things that business owners still feel like they need to be doing. Your time is much more valuable working with a right advisor. You'll get that ROI, and then you can skip the stress of having to do things yourself. All right, we're going to spend time on deductions. So this is an area where we get a lot of questions when it comes to tax planning. One of the key things that business owners have been told or trained, it's maybe this great misconception about tax planning, is that you need to spend all your money, liquidate all of your cash in order to save taxes. That is not necessarily the best strategy. Eliminating all of your cash puts you in a huge cash crunch in the first quarter of the year and can really set back your business in terms of taking advantage of opportunities. So spending money just to get deductions so you can save on taxes is not an effective tax strategy. It may be one component to contemplating how we accelerate some expenses, but we're always thinking about how do we maximize the ROI, not only from a tax standpoint, but other aspects of our business. The other thing that a lot of people don't think about is that when they are going to spend money and get deductions is that I'm just going to eliminate my tax liability to zero. But some of the deductions that they are getting, if they're in a very low tax bracket, are not worth very much from a tax perspective. You know, why would you want to spend $1 to save 10 cents versus spending $1 to save 37 cents? So strategically evaluating when those deductions are the most valuable in this bracket management concept. That's strategic tax planning, not just tactically trying to reduce your tax liability to nothing. Deduction do's and don'ts. So we on our website have a deduction do's and don'ts guidelines for you. I would highly encourage you to go out to our website and download those, take a look at them. What I want to remind everybody about today is that deductions, when we're talking about those in the scope of a business, is the IRS looks at those expenses that are ordinary and necessary in the course of your business. Your business is very different than other people's businesses. So it is important to understand what you should be documenting in terms of business reason, the reason for that expense, and also maybe who is present, what the nature of the expense was, and even a defense position on why this is relatable to my business. An example of this might be dog food. Dog food for a pet grooming business may be an applicable expense because they need to feed dogs while they are there for their grooming. But for a hair salon, that would not necessarily be a ordinary and necessary business expense. Those types of differentiators exist all over the business spectrum. So contemplating those types of things are really important, justifying them, and as the IRS likes to say, contemporaneously documenting why that business expense was important, so that later, should your expenses be scrutinized, you've got the proper support for that. Okay, so again, I would highly encourage you to go through and download those deduction do's and don'ts. It is important to understand that fast and loose is not going to cut it anymore, especially for those high income earners. You really have to have your I's dotted and your T's crossed. The IRS has already come out and made some very bold enforcement promises about high income earners. So it is going to become even more and more important that you are really, really focused on maintaining good records to support your tax positions, and that includes deductions in your business. All right, let's talk a little bit about accountable plans and the home office deduction. This is another reason why you're really going to have to spend some time as a business owner, making sure you got those I's dotted and T's crossed. And that is that you need to have the proper documentation in place in order to take and be reimbursed for certain deductions. And that includes the home office deduction. An accountable plan is like a policy that you put into place in your business to make sure that you have the appropriate documentation to support making those reimbursements. If this is not something that you have in place, you can email me at susan@unboxedadvisors.com, and I will email you a template of an accountable plan. And if you're not taking the home office deduction, or you're not familiar with what those rules are and whether or not that's applicable to your business, even if you actually do have an office, then I'm more than happy to chat with you about that and send you our template for what that looks like as well. Especially with the advent of the pandemic and a lot of other people moving to hybrid and remote work positions, the home office reimbursement template is something that's highly underutilized. There's a huge misconception that the home office deduction is going to send up red flags with the IRS, and that's simply not the case. Now, as with most things pertaining to the IRS, it has to be done properly. And that really means that you've got all of your ducks in a row and you're doing things correctly so that you're not creating more risk unnecessarily when it comes to compliance. The home office reimbursement can be an extremely valuable deduction for you because it's ultimately converting what is a personal expense to a business deduction. And that really allows for you to get cash out of your business in a tax-free way. The way that our home office reimbursement calculation template is structured, and the proper way to do this calculation is to take the percentage of your home that's used as an office. And of course, it must be designated office space. So like kitchen table is not going to work, part of the dining room table, not going to work. So it really does have to be designated office space. But that percentage of your home that's applied or used as an office, that percentage is applied to then mortgage interest, real estate taxes, and all of the other costs used to maintain your home. That includes utilities, landscaping service, pool maintenance, housekeeping, and even things like HOA dues. So there's a litany of expenses and even some fraction of those that could be captured and become deductible in your business. That can unlock, again, that whittling away of these expenses. It is always an important practice to contemplate at the time a transaction is initiated, whether it's business or it's personal. Many times that means that people who are running a business, they've got a couple of different credit cards they're using. They've got their personal card and their business card. And it's important to note that at the time of purchase is happening, to be thinking about, is this business or is this personal? So keep that in mind too. All right, let's talk about the Augusta rule. This is truly a favorite among business owners. And anytime we do any type of tax planning, it's something that we always ask about. It's something that at the end of the year is really not going to help you. It's something that you need to be thinking about at the beginning of the year and be super intentional about planning and tracking. So I'll give you kind of the basics of the Augusta rule. So the Augusta rule allows for a business owner to rent their personal residence or even their vacation home to their business for up to 14 days during the year, and for the business to pay rent, and that's the fair market value of that rental. And there's many ways to determine that. But on the personal side, now you don't have to pick up that income, that rental income. So as you can imagine, that can result in a significant amount of deductions. Now, there has to be, of course, a legitimate business purpose for the use of the home. But if you think to the many opportunities that you might have to use a residence for either a strategic board meeting, a employee meeting, a party, a holiday party, a customer appreciation event, there are a multitude of ways that you can orchestrate using your home from a business perspective that would allow for you to pick up this extra deduction. Again, tracking is key. This is not going to be something where you can just go back and make stuff up. That's not going to be, it's not going to hold up. It's really important that you are using your home for those purposes, but you're also tracking it. So we got a Augusta rule transaction tracker for you. So if you'd like to have a copy of that, email me at susan@unboxedadvisors.com and I will send that to you as well. The last thing that I want to talk about on this is just the double-edged sword of deductions. If you have other financial priorities in your life, things like I want to buy a new home, or I need to get a line of credit, or there's some other reason why you need to have more income, then getting the most deductions is not going to help you serve that purpose. So you really have to think about driving taxes down by maximizing deductions or achieving those other purposes, those other financial goals. It's just something, again, in the planning process, you really have to think about. Okay, I'm going to try to speed things up here because I know we've got a lot to cover. All right, key business strategies. The Section 199A deduction. So in 2018, the Tax Cuts and Jobs Act, there was a new code section that was formed, and it's called the Qualified Business Income Deduction, or Section 199 Cap A. The important thing to know about the Qualified Business Income Deduction is that for most business owners, it's free when it's optimized in the right way. And who doesn't want a free deduction? Those are really, really hard to come by. However, most people are not spending any time thinking about how to optimize the deduction to get the most out of that 20% deduction that they can. So if you are unfamiliar with what that means or whether your business qualifies, this is the exact type of discussion you need to be having from a tax planning perspective. And now is the time to be doing this so that you can make sure that you do not pay yourself too much or too little. And I call that really kind of the Goldilocks wages. Your wages have to be just right in order for you to get the most of that deduction. The importance here is that you have to understand whether or not you qualify. If you are a physician, accountant, attorney, financial advisor, consultant, or a celebrity, then there are some income limitations as to whether or not you qualify to get the maximum deduction. Again, can that be managed? Absolutely, so that you can optimize it. And what I want to tell you is that it is a very important deduction for you to take advantage right now because it sunsets at the end of 2025, unless Congress does something to extend it. And right now there is pending legislation, but we shall see if that takes effect. We all know that there's a lot of different elements that come into play from a political perspective as to whether or not that's going to be increased. However, if we do not see it renewed, there's going to be even more tax planning that needs to be done. Depreciation. We often see a lot of mistakes made when it comes to depreciation, and the main key is timing. Timing of buying assets to maximize deductions. Again, thinking about the strategic timing of when that deduction is the most valuable to you, super key. Also, understanding the difference between Section 179 depreciation and bonus depreciation. Bonus depreciation right now is at 80%, set to decline by 20% until it fully is at 0%. So, and that's over the next several years. So this is a good year if you are buying assets to use that depreciation. The difference between bonus depreciation and Section 179 depreciation is that Section 179 cannot put you in a loss position in your business. Bonus depreciation can. Very important distinguishing factor there, and both can be utilized in different ways. So strategically important considerations. If you own real estate, understanding what it means to be a real estate professional and or be active in that business, that you could qualify for additional depreciation in the form of a cost segregation study on the real estate. And if you are not familiar with what that is, then I will have information later for you on our next webinar where we're going to talk about all things real estate. Retirement planning, we're going to talk a little bit more about that today, so I'm not going to spend time on that because we've got some details we want to go over with you there. But retirement planning can be very effective in decreasing the amount of taxes that you're going to pay. Writing off inventory, if you have an inventory heavy business, things that are not necessarily big assets, but property that you have available for sale, then you might have the ability to write off all of that inventory and take it as a deduction in the current tax year. And that was also made available under the Tax Cuts and Jobs Act. Will require a Form 3115 application for change in accounting method to be filed, but could be an extremely powerful tax deduction if you have inventory in your business. And finally, the two other things that I want to talk about are entity structuring. If you are willing to accept additional complexity to save tax dollars, that may be moving from a Schedule C to an S Corp, having a multitude of entity types, S Corp, partnership, and C Corp, then playing in all of those sandboxes unlocks different parts of the tax code to save you significant dollars and become more strategic in taking advantage of the specific things that are available in each different type of entity, because they are different. A single member LLC filing on a Schedule C is much different than a C corporation. Taxation is different. Opportunities for deductions are different. So understanding how your businesses are structured and whether or not there are reasons to set up additional types of businesses and entity types in order to leverage all those different parts of the tax code, often extremely missed, but can be very valuable. And lastly, really paying those kids. Get your kids and possibly your spouse working in your business can open up various opportunities to not only save on taxes, but to also begin to build wealth, retirement planning for your kids, as well as moving things out of your estate. Even tiny bits of estate planning can be done by really moving funds out of your business and into your kids' names. So there are effective ways to do this. I will tell you that many times business owners who have S Corps are doing the incorrect treatment of paying their kids out of the business. That is not the way to pay your kids if they are under the age of 18. If they are under the age of 18, you want to pay a management fee out of your S Corp to your Schedule C, and then from there pay your kids so that you can completely avoid Social Security and Medicare. So an important consideration. We see that mistake a lot among business owners. Right. Other areas of the tax code that you really want to think about, and I'm not going to spend a ton of time here. However, if you are paying income taxes in other states, so your business operates in other states and you are filing income tax returns in multiple states and paying taxes there, ultimately, it may be important for you to understand that there is, for a great number of states now, the ability for the business to pay those taxes so that you as an individual do not have to. The great thing about this from a tax perspective is that if you pay it personally, it gets capped at that $10,000 limit on your Schedule A. But if the business pays it and you make that election, then the business gets the full amount of the deduction. So you avoid that limitation on your Schedule A on your Form 1040. That can be extremely powerful. People are saving hundreds of thousands of dollars by making those elections. Now, Are there always considerations that you need to be aware of in terms of the timing of the deductions and making sure that those taxes are getting paid so you're not incurring any unnecessary underpayment penalties? Absolutely. So again, goes back to proactive discussions about what is happening when and whether those deductions, whether those elections really make sense based on the dollar amount and the planning and the timing. Let's talk a little bit about captives. Captive insurance, they are an excellent business strategy. So they really function in a couple of different ways. The first thing that they do is they help you to mitigate risk that you are not insuring in your business. And they also serve as a way to save taxes. Many business owners have risk that they have that is not commercially insured. So don't think like property and casualty or workers' comp, but think things like business interruption, cyber crime, even things like concentration on a supply chain, on a customer. There are many different risks where if something happened to a specific part of your business, it's not really insured. The way that a captive works is that once that risk is evaluated, the premium is determined. That dollar amount of premium that your business would pay becomes a deduction. If it is under the statutory limit, which is in excess of $2 million now, when it is paid over to your newly formed private insurance company, there's an exemption on the income tax it must report. And so there is no income tax due when that income is reported in the private insurance company. So if you can imagine, you're saving a significant amount of dollars in your business by the deduction for the captive insurance premium, but the insurance company is not paying income taxes on that money it's receiving. Very powerful. The arbitrage on that is huge. As you go down the road, and if you don't have any claims in your captive, then you have the ability to take that money out later, and that would come back to you as a qualified dividend. Yes, you must pay tax on it at that time. However, it's been shielded from taxation at the highest ordinary income tax rates, and now coming back to you at a lower qualified dividend tax rate. Not to mention, there are other benefits, such as those funds are outside the purview of creditors. The owners of those insurance companies could be the same, if not different, from your business. So there's different ways to structure that so it can be extremely beneficial. A few other areas of the tax code that may be not as well known and have received some recent attention. The research and development tax credit, there's been some big changes to that. Congress did not renew the fact that tax R&D expenses are expensed in the current year, rather they're amortized over a 5-year period. It's changing that tax credit. Still might be worth understanding so that you know if there is a renewal in the R&D tax credit, the old way that it was handled, how that could be beneficial to you in the future. Again, education is key. And then the 45L and the 179D. The 45L is a tax credit, 179D is a deduction, and those both relate to energy savings. One for multifamily, that's the 45L, and one on commercial properties, that's the 179D. The interesting thing to know about the 179D is that it could relate to the designers, architects, and engineers of properties. So you don't necessarily have to be the owner or the contractor on the job. You could be the designer and benefit from that 179 deduction. And that might not only be restricted to for-profit commercial properties, but also nonprofit entities who are building energy efficient buildings. So universities, schools, churches, other things like that. All right, and then lastly, charitable giving and managing investment results. This really pushes more towards the personal, but kind of zooming out and looking at everything from a very holistic perspective. It's important to think about if you do have high income years and you are charitably inclined, leveraging the tax code, whether that's in the form of creating your own private foundation, or perhaps even a donor advised fund, if you don't necessarily want to go the way of having your own private foundation, how that can really be leveraged to drive your taxes down while helping you to achieve, other important goals to you personally. And lastly, making sure that you're working with your financial advisor to really leverage investment results or understand how your investments might impact your taxes. In a lot of cases, I have seen people who receive capital gain distributions and they're surprised by the amount of tax they have to owe because they didn't even know that was something that their mutual fund could possibly even issue to them. These are big considerations. And again, communication is the key. Real estate. So investments in real estate, I will tell you that if you are a successful entrepreneur, the first thing you're going to come to me and ask is, hey, does it make sense for me to buy this real estate? And I totally understand it because real estate is a safe investment land is an appreciable asset even under the tax code. So people, when they're successful, they make a lot of money, they then begin to invest in real estate. We understand that and we want to make sure you have information on that. So we are doing our next webinar on October the 27th at 10 a.m. And we are going to be talking about all things real estate. We're going to dive more into the 45L, the 179D, cost segregation, short-term rentals, residential rentals, the whole thing. So you understand all of the components of what it means to be a real estate investor from a tax perspective. All right, today's deep dive. So in the remaining time we have today, I really want to spend some time talking about a case study and talking about mainly in this particular instance, what it means to leverage retirement planning. All right, so many people don't know about what's referred to as a defined benefit plan or a cash balance plan. And there's a lot of confusion about what type of retirement plan I really should be choosing. And there are a lot of different choices. IRA, SEP IRA, a simple 401k, all the way up to, and this is really the maximum benefit you can get out of retirement planning, and that is a defined benefit plan. So I want to start with just talking about limits. It is really important to understand what you can contribute to a 401k and ultimately to a defined benefit plan. So a 401k, as you are probably familiar, is what's referred to as a defined contribution plan, meaning the contribution that you're putting in right now is defined, and that is limited by the law. And this year, for 2023, the employee contribution is limited to $22,500 unless you're over the age of 50, and then it goes up to $30,000. Then business owners have the opportunity to implement a matching. And I'm certain that most of you are also probably familiar with what a match looks like. And that can be up to 6% of your compensation. And that is an employer paid and an employer deductible expense. And that can be very powerful in terms of not only savings for yourself, but also for your spouse. Then let's talk a little bit about what a defined benefit plan is. A defined benefit plan is a plan where you're contributing today, all right, and the benefit in the future is what is going to be defined. There is an actuarial calculation that has to be completed in order to determine, based upon your compensation and your age, how much you can contribute so that when you retire, you receive that defined benefit. So hence the difference between defined contribution and defined benefit. The really amazing thing with a defined benefit plan is that the maximum contribution in 2023 is $420,000 per person. That is a significant amount of contribution that can be made. Now, I'll stop here for a second and just chat a little bit about what it means to have a 401k and a defined benefit plan if you have employees. So both of these plans are otherwise known as qualified plans. That means under ERISA, which is a set of laws that governs retirement planning and plans that are allowable under the law. That means that they have to be fair. There has to be some equitable treatment if you have other employees. So for example, if you have a 401k with a match that has 6%, 6% compensation match, then that 6% is applied to all of your employees. The same would be the case in a defined benefit plan. However, it is weighted in favor of the people who, the employees who are earning the most and who are older. So a feasibility study is typically completed to help a business owner understand what are my obligations going to be to fund the defined benefit plan, not only for myself, but any other eligible employees. And this is a great consideration. So generally speaking, small offices, so individuals who are either, sole owners of S corporations where they're employing themselves and their spouse, or for example, physicians' offices where it's maybe just the physician, their spouse, and maybe a couple of their key employees. This could be a very effective strategy because although there might have to be a contribution to the defined benefit plan for those key employees, it is much greater for the owner and their spouse who are working in the business. And so that makes it very attractive. Not to mention, it can also be an extremely, extremely effective way to retain key employees, especially those employees who have been extremely loyal, who you want to make sure you keep, on board. They're talented A+ team players. You really want to make sure that they are, staying with you. And as we all know, any kind of turnover in a business is extremely expensive. So maintaining your staff can be highly, highly advantageous. Okay, so the first step in this process, and this is what I want to make sure we can go over in detail, is that you have to identify who the plan administrator is going to be. So you're going to work with a company that really will facilitate the feasibility study. They're also going to facilitate all the trust record keeping. They're going to help you create the plan document and make sure that you stay in compliance with all the rules and the entity reporting requirements, not only for the 401k, but also for the defined benefit plan, because legal entities are created when those plans are formed and they have their own IRS filing requirements. And that's not to scare you to say, oh no, you're going to have more to do. You pay somebody and they handle it for you. And it's worth every penny to get that off of your plate. So they are experts. They know what to do and how to do it in the timing, and they help you manage all of that. So just keep in mind that that's really the selection of that company to do that for you is the key. Many times, always, this is what falls to us in order to take care of it. We don't put that burden on our members. We do it for them so that they don't have to worry about any of those activities. Okay, another consideration in all of this is determining not only what we want the contribution to be to the defined benefit plan and to the 401k, but how are we optimizing QBI in the mix? So this is it's a three-pronged approach. We're looking at many different avenues when we're really planning out what do we want that defined benefit plan to look like this year based on the income that we have, expenses that we have, and how do we optimize the QBI as a part of that. If you are in one of those categories where your business may not be eligible to benefit from the QBI once you exceed certain limits, so physicians, dentists, accountants, attorneys, financial advisors, sometimes this particular type of strategy will help get you under that particular income threshold so that you can get more QBI benefit. So things to think about there. Oh, wait. And then I wanted to spend just a few minutes talking about cash requirements. It is important to understand all of the elements of cash that are going to be related to funding the 401k, the defined benefit plan, and ultimately the Social Security, Medicare on the payroll, and the income tax liability for the year. So cash is a really big component in evaluating exactly what you want to do. And I'm going to show you a spreadsheet here in just a minute where we've kind of gone through and provided some scenarios that really evaluate for help the member, really the business owner, evaluate where do you want to spend cash. And we provide a lot of advice on what we think is the best course of action based on how you're going to leverage the cash, what our other priorities may be, not only in the business, but when we zoom out personally. Okay. Here is a really a good picture as to what it is that you can do in a business when you leverage fully the 401k and a defined benefit plan. So here's an example where we have a husband and wife team. They are in their 60s, so they are approaching rapidly retirement. So they're really planning to fund for the next probably 5 years a defined benefit plan, and after that they're likely going to plan to retire. So you see here, we have a significant amount of money that we can shield from taxation, the salary deferral, the profit sharing, as well as everything that goes into the cash balance plan, resulting in a total contribution, possible contribution of up to $775,000 into retirement. And that tax savings is over $250,000. I mean, approaching $270,000. And that's just 1 year. Next year will be something altogether different. So if their income continues to rise, the tax savings compound. Now, of course, does this strategy work for everybody? Not necessarily. And are they going to one day have to take this money out of their retirement account and pay taxes on it? Absolutely. So we have to be thinking strategically about, does this make sense for this particular customer? So let me give you an example of this. In this case, we've got a husband and wife team. So if one of them were to pass away, once this is fully funded and they're retired, all of the surviving spouse would inherit the assets, from the spouse who passed away, and could continue to use those in his or her lifetime. However, if we've got one individual who owns a business and they have no heirs, or let me make this assertion: if they have adult children who are their heirs, and their adult children inherit an IRA from them, then those adult children have to recognize that income over a 10-year period. If those adult children are very successful, then we've created a tax problem potentially for them, because they are required now to take that money out in their highest income earning years. This can be very challenging for them. Yes, of course, it's they're going to have to take out more money to pay those taxes. But if it is important to the person who is building this, that their children have a certain amount of money in an estate planning process, depleting that with taxes could be disastrous and really be burdensome to their children. So, it's really important to think through when these things are the most effective. Okay. I am going to pause. I'm going to unshare now, and I'm going to move over and share a screen. I want to make sure you look at these options that I have prepared for you here. Okay, and so you should be seeing now my spreadsheet. So I want you guys to just look very quickly here at, and this is important for you to understand, what the possibilities are in terms of scenarios. So we've got a situation where we are looking at a potential business income dollar amount sitting at $1.5 million. And then we're looking at the different possibilities of wages. So keeping the taxpayer wages at the maximum wages in order to facilitate the maximum benefit, and then reducing the spouse's wages to look at the different options in terms of funding the defined benefit plan. So you can see under our first scenario, the maximum contribution and as it goes down. And what I want to correlate to you here is that in one situation, we get no QBI deduction, and it increases as we minimize that contribution to the defined benefit plan, so we can begin to benefit more from that QBI deduction. Again, these are the things that you really have to be thinking about from a tax planning perspective. All right, now I'm going to scroll down here, and I want you to look at two other key important things here. And that is not only how this changes the tax liability, right? So going from, if we make the max contribution, we're going from roughly 130K in income taxes to roughly 200K in income taxes. But our cash requirements that change in funding the maximum defined benefit plan and 401k contributions to, roughly $416,000 with the defined benefit plan contribution. There are significant cash differences, and even though the taxes may go up, the cash that might have to be expended is radically different. So my point in showing this to you is for you to understand that there's multiple considerations when you are doing planning like this around retirement. It is not only looking at what we can contribute, but what we're going to pay in taxes, how that's going to impact other deductions that we might get, and the total cash outlay in order to achieve all of those savings. So I just really wanted to make sure that you saw that there. So I know that's a lot of detail, but if you are considering a defined benefit plan, this is what you need to be going through every year with your tax advisor so you can really understand what that looks like. All right, I'm going to go back to the presentation here, and I'm going to answer any questions that might have come in. All right. Right. Catherine or Brittany, can you guys tell me if there are any other questions that might have come in during our presentation here? Let me see if I can pop over there too. Okay, it looks like we have a question related to how do I know what type of entity to choose? That is a great question. One of the most important things for you to really be thinking about is when it comes to entity choice is what your business does, what your particular tax situation is, who the owners are. There are different rules in the business when it from a tax perspective when it comes to what type of business you want to choose. Also, when it comes to how income and expense might be allocated or how distributions might be allocated. This would be a perfect opportunity for you to meet with someone like us here at Unboxed Advisors to really help to provide information for you on how to choose the right entity based on what you're trying to accomplish and who you might be in business with, as well as really helping you to understand all the different elements of how those different business types could impact your taxes. So I would highly encourage that. I think there are a few other questions, but we're almost out of time. Oh, hold on, one more question. What should I expect from an accountant who I hire? Okay, that is an excellent question. So when you hire an accountant, there's a few things that you should expect, that you need, and that you deserve. The first is communication. You deserve proactive communication from this person. And I'm not talking about every year when they fill out your tax return or send you a tax organizer. You need to be having scheduled ongoing discussions with your accountant so that they truly understand everything that's happening in your financial world or the things that you're planning to happen. So that's number one. You deserve a response when you ask a question. That is really important. You need guidance on a regular basis. And that means that even if it's busy season or there's something else happening from a business perspective for the accountant, that they still have the ability to get back to you in a timely manner so that you have the support you need in your business. The other thing that you need is you need a holistic solution. So you need someone who is not only going to help you understand if your accounting is done right and help you get it done right, but also help you understand how to leverage technology to automate it to its fullest, to understand how to work from a tax perspective, not just meet the deadlines, but to work proactively to minimize your tax liability. And lastly, to work with someone who will ask good questions to move you in the current state you are to the desired state you want to be. So if you're short on cash, how do you get more cash? If you want to reduce expenses, how do you reduce them? If you want to grow your business, how do you grow and scale it? So all the different elements that are happening in your business. You have poor employee retention. How do you increase engagement and increase retention? How do you improve your hiring? How do you build a better culture? Not that we're going to be the ones to, as accountants, to help you to solve all of those problems, but it's to help you correlate what is happening in the operations with what is happening financially. It is truly a mirror and a reflection of your business. Your operations really are the key to seeing all the things that are happening in your business. So, choose wisely. Choose someone who that you get along with, you feel like you can partner with, that you know, like, and trust, and is going to work with you and not really view you as a number. Someone asked a question about audit risk on captive insurance. Great question. Yeah, captives can be a little bit more on the risky side when it comes to an aggressive tax position. However, when you work with the right companies who are facilitating the setup of the captive, they are also providing audit defense. And so that really becomes an important part of understanding. Make sure you're working with a reputable company when you're setting up a captive insurance company. Also, I think it's important to understand that there are some captives that are far more risky than others, and that would be offshore, exceedingly risky. Domestic, much less risky. So also understanding this, there are also service providers who will push the limits as well. This is not unlike anything else. Even the employee retention credit. I mean, we've seen, massive changes, with, companies setting up shop and trying to get stuff done just to take advantage of the tax law. And are those companies going to be around to really support you, if you get audited? Working with someone reputable, working with a reputable service provider is really the key. And that's really where we come in, because we vet the service providers to make sure that they are all done. And they're good. Well, I think that's all we have time for today. So I want to thank you so much for being here. For additional downloadable treats and gifts, please visit our website at unboxedadvisors.com. I would also like to invite you to join me today, along with Brandon Hurwitz from Underwood Perkins, at 1 p.m. on my LinkedIn Live, where we're going to discuss the Corporate Transparency Act. If you don't know anything about that, this would be a perfect time to jump in and learn all about it. It's only 30 minutes of your time, and it's going to affect almost every single business in America. So really, really important stuff there. I would follow us and hop in on there. Also, don't forget to, check us out on LinkedIn, follow Unboxed Advisors there, on Facebook, and check out our YouTube channel too, where you can find many other videos relating to holistic business advice. And then finally, I want to invite you to download my free ebook at unboxedcpa.com/10 mistakes, and that's 10 mistakes. And we're dropping that in the chat right now. Otherwise, I wish you all happy tax planning. And if you want to reach out to me, as always, Susan at unboxedadvisors.com, or connect with me on LinkedIn. It's been a pleasure being with you here today, and have a great day. Thanks.